I wanted to talk about the 5 ideas underlying what the president has called for in business tax reform. The first thing is cutting the tax rate from 35 now to 28%. So the president's proposal would actually expand that and make it permanent and to some degree simplify it as well. So you have to have some structural changes in the tax code and ask yourself, are those trade-offs worth it? And the 2 structural changes that we would need some combination of in order to get the type of rate reduction we want are, number 1, shifting away from the accelerated depreciation that's in the tax code today that lets you depreciate assets faster than they actually depreciate economically, and towards something that's more like their actual economic depreciable lives. And then the second one is addressing the deductibility of interest and potentially doing something about that in some form. The third part of the president's approach is the international system. As I said, our goal is to move from a system today, which is the worst of all worlds, to a system that allows more global competitiveness, but one that also takes more seriously the problems associated with base erosion and tax incentives to locate inefficiently overseas. And our proposal is that wherever you operate in the world, you would face a 19% minimum tax. The fourth part of the president's approach is to simplify and cut taxes for small businesses. And you'll see this is called business tax reform, not corporate tax reform. And I think that's quite important because you need to think about the business sector as a whole. The way we proposed to do that is we took an idea that the National Federation of Independent Businesses, NFIB, had to raise what's called the Section 179 expensing, how much business investment a small business can expense. They said raise it to $500,000. We said we'll see you in W, and have proposed to raise it to $1 million. We do that in conjunction with allowing small businesses to shift from accrual accounting to cash accounting, which would be a simplification and a tax cut as well. And as a result, the plan would simplify and cut taxes for small businesses. The final part of our approach is that in the transition to a new tax system, we raise some temporary revenue from a 14% charge on all the overseas earnings that are already overseas. That one-time revenue we wouldn't want to use to pay for permanent tax cuts because that would mean the deficit would increase outside of the 10-year budget window. So we take that money and invest it in infrastructure, putting it into the Highway Trust Fund to pay for a one-time 6-year reauthorization of surface transportation. That leaves the plan budget neutral in the first 10 years and then fully revenue neutral over the medium and long run. These are the basic elements of the approach the president has outlined.